Hey guys, what's going on? This is John from Friends with Your Benefits. You may have heard that stop loss insurance is an important risk mitigation strategy that many employers who happen to have self insured health plans actually use. But what exactly is stop loss, and what do employers need to know about their stop loss policy? Joining us today to learn more about that, we have Mehb Khoja from BCS Financial Corporation, Chief Actuary and overall expert on all things stop loss. Hey, Mehb, how's it going?
Going
Welcome to
great,
the show.
John. How you doing?
Doing well. Thank you so much for joining us today.
I'm happy to be here.
How long have you been doing stop loss now?
Too long. I actually have been in the stop loss space for probably 15 or so years.
Definitely. I'm sure a lot has changed in those last 15 years.
No doubt about that.
So let's go right into it, right? I mean, the latest stat that I saw is stop loss is roughly a $33 billion a year industry and is very important for clients. And now that we're about to hit the fall, many clients are taking a look at their stop loss policies and they're trying to make sense of it, right? So, just as a refresher, can you give our audience just an overview on what stop loss actually is?
Yeah, absolutely. And you're right. It is a $33 billion industry. It's actually been growing at a very rapid pace because many employers have been moving self insured as opposed to being fully insured. And really, what stop loss insurance is meant to do is it's meant to provide volatility protection for those self funded employers. So, employers who want to pay the claims of their employees and their members, but they only want to pay to a certain point. So if individuals have really high cost claims like a heart attack or a high cost hospitalization, they want to have some level of cap. And that's what stop loss is intended to do. It's intended to give that employer a cap so that they don't have to pay anything above that level.
Fair enough. One additional, I guess, question, right? And some employers have both forms. Some may have one form over the other.
Mhm.
So, a common stop loss term out there, a common stop loss policy provision is an aggregate stop loss. And then there's also individual or specific stop loss. So,
Mhm.
what's the difference between the two?
Yeah, so individual stop loss is basically how it sounds. It's coverage on a per person basis. So, really easy example is let's say you have $100,000 of individual stop loss. Each of your members on the plan, the self funded employer will take the first $100,000 of claims expense. And then beyond that, it's ceded over to the stop loss carrier. So that's individual, and that's usually the easiest one to understand. And then there's aggregate, which is coverage over all of your healthcare spend. And typically that's on a percentage basis. So what happens is the stop loss carrier and the employer will agree on an expected cost that the total claims will run in the year. And then aggregate coverage will add a layer on top of that. So let's say it's 125%. A lot of people like to think of aggregate stop loss as like budget protection. So you set a budget. If it goes 25% or more over the budget, you're now basically ceding that liability over to the stop loss carrier.
So one, I guess, common question I see. So aggregate stop loss tends to be popular with smaller employers, right? Those
Mhm.
employers who have, let's say, fewer than 1,000 enrolled employees on their
Right.
self-insured plans. But when you get much larger than that, you see that many employers decide, hey, I'm going to waive the aggregate coverage and I'm just going to have the ISL or the
Mhm.
individual specific stop loss coverage. Why is that?
Yeah, it's because smaller employers, a large claim can just be very volatile for a smaller employer. And what happens is most stop loss carriers will have a minimum deductible that needs to be satisfied regardless of the size of the employer. So let's just say you're 100 employees and the stop loss carrier marketplace says at minimum you have to take on $100,000 per person risk. Well, that's a lot of volatility for a small employer. It's not a lot of volatility for a large employer, say a couple thousand employees. But if you're 100 or 200 employees, that's a lot of risk to take on. And so it's really common for smaller employers to want to have like this budget protection, which is aggregate coverage. But I'd say once you get to about 1,000 employee lives, that's around the time when employers start to rethink that coverage. It's not very expensive coverage, so a lot of times CFOs think of it as like sleep at night protection. But you get to a certain size where you're really paying for coverage that you may not need. That typically happens around 1,000 employee lives.
Now, one question that I've gotten from clients and prospects over the years is, hey, John, let's say I have 3,000 employees. Is
Mhm.
it possible to just have aggregate coverage without the ISL, or do you really need the ISL in order to get the aggregate coverage, and why?
Yeah, that's a really good question. And that product is not available by most carriers because the Stop Loss Model Act doesn't allow for it in many states.
Hmm.
So, what that act basically says is there's a minimum deductible that a carrier and an employer need to agree upon. And so, without that, you basically can't have aggregate coverage. If an employer wanted aggregate only coverage, their best form of achieving that is buying fully insured coverage.
Hmm. Very interesting. And then another question that comes up too, right? So stop loss deductibles, I assume they reset every year. Is that true?
Yeah, they reset every year, but the accumulation of the deductible could look a little bit different policy to policy. Sometimes contracts are written to be a paid contract, and sometimes they're written to be an incurred contract. And depending on that accumulation factor, the deductible is definitely reset, but the dollars before they get reset may look a little bit different between those policies.
Okay. Now, here's the favorite stop loss question that I get every single fall, right? So, client out there says, "Hey, John, I have a 60% stop loss ratio, right?
Mhm.
I'm expecting a flat renewal." We get the renewal from the stop loss carrier, and if it's a good renewal, it's maybe a little lower, perhaps it's 15%. And
Mhm.
then other times we see the renewal being 25% or more. So, can you explain to our audience and to employers out there why stop loss renewals tend to be a multiple of medical trend?
Yeah, it's so the easiest way to think about it is to start with a numerical example, right? Let's say you have $100,000 deductible and a $300,000 claim. And so basically the stop loss reimbursement should be $200,000. Now, if that same $300,000 claim inflates next year by 10%, so a $300,000 claim becomes a $330,000 claim. On that same stop loss policy, the deductible stayed flat at 100,000. And so now instead of being $200,000 in liability, it's $230,000 in liability. So the way a stop loss carrier measures trend, it's a little bit different. It's called leverage trend because that deductible may not be changing. So typically stop loss rates will go up roughly double what underlying trend is unless the employer is increasing their attachment point or increasing their deductible. When they increase their deductible, then your rates should go up roughly the same as your underlying healthcare spend.
So, in other words, if the stop loss deductible isn't increasing every year at the same rate as the assumed medical trend, the employer is inherently getting a better benefit or higher reimbursement every year, right?
That's absolutely correct. So that's why most stop loss carriers will ask employers to increase their deductibles, maybe not every year, but at least every couple of years.
What's the laser out there, right? So we think of lasers. I think of Star Wars, right? And clearly,
Yeah.
lasers do apply to stop loss, but has nothing to do with Star Wars. So can you explain what a laser is?
Yeah, so a laser is a stop loss carrier's way of excluding an individual either from coverage altogether or from having that individual at a higher attachment point. So recall from my previous example, stop loss deductible of $100,000. Now, stop loss coverage is for unknown claims. In the event that a claimant is known, so that $300,000 claim example, let's just say for the sake of argument, it's an individual who's using some type of specialty medication and they're going to be on this treatment every single year for the remainder of their life, and the cost of the drug is $300,000 per year. That becomes a known claim. And the purpose of stop loss insurance, and really the purpose of any insurance, is to protect from the unknown. So when a claimant is known, typically a stop loss carrier may either exclude that individual from coverage or increase the attachment point that the employer is taking on. And in that same example, let's say we know it's a known claim of $300,000. It's likely that the stop loss carrier may laser that individual at 300,000 and tell the employer, you know that this drug is going to cost $300,000 a year. So you guys take on that liability. And if in the event it's higher than that, we'll take on the liability. And I'm sure I know where your next question on this is going. It's like, what the heck? Why do stop loss carriers do that?
Sure.
And again, really, the reality is that insurance is meant for protection from unknown claims, and the concept of an insurance carrier pushing back liability where risk is known, that's inherent in insurance. If you think about like auto rates, if you have a drunk driving on your record, your auto rates are probably higher. If you think about life insurance, if you're a smoker, then chances are your life insurance rates are higher. And what's really prevalent right now is the cost of property insurance. And so
Yep.
if you live in the state of Florida, chances are your flood coverage, your wind coverage, those things are higher because you're just prone to more risk. So that concept of needing to cede liability to higher risk, cohorts in insurance, that happens across the entire insurance landscape.
So one thing that you touched on was exclusions a little bit, right? So aside from lasers, are there any other exclusions that employers should out for? And candidly, many employers, right, aren't experts as it relates to stop loss. That's why they hire brokers and consultants to make sure they
Yes.
understand it. But are there any particular common exclusions that you see? Or I guess putting this another way, if you're an employer, how do you know that there's no gaps in coverage?
That is a very tricky question. And so there's a lot of places within a policy where there could be some exclusions. So you really have to know what it is you're purchasing. So something that we see happen, unfortunately, too often is not buying run-in protection. And so let's say you're self-funded in 2023 and you intend to be self-funded in 2024, and you're looking to renew your stop loss policy, and you're given a proposal from a new carrier, and it just looks so much less expensive than your current. A lot of times what we see happen is when business transitions from one year to the next, a stop loss carrier may not include run-in protection, and that could be worth anywhere between 20 to 25% of the total spend. So you may be looking at that premium thinking, hey, it's a discount, but in reality it may not be a discount. Another area where we see is, right now there's a lot of shifting of networks from using traditional networks like the Blues, Aetna, Cigna, United, perhaps even rental networks that are available through TPAs, and shifting over to reference-based pricing. And in a reference-based pricing setup, there is no network. There's some pretty strict hospital negotiation that happens at the time of a claim. And the result of that could be a much lower spend on the hospital claim. And a lot of times, stop loss carriers will give discounts for that. Now, what we've seen happen is when a broker asks for multiple quotes and they're asking for an option with my current Blues network as well as reference based pricing, there could be a stark difference in that price. And if the employer selects the option with the reference based pricing, but doesn't actually change networks, that opens up a gigantic possibility for a gap in coverage.
Sure. Yeah, and that's definitely something that employers want to avoid. So, speaking of premium rates, right? So, if you're an employer, how do you first know that your premium rates are fair? And then, secondly, right, like how do you know like whether or not your deductible level is appropriate, right? And clearly part of it's going to be risk preference and how much risk tolerance an organization's willing to take. But curious to hear your perspective.
Yeah, so as a stop loss carrier, we typically advise employers to assume roughly 100,000 to $150,000 deductible per 1,000 employees. That's just kind of a broad rule of thumb. Some employers don't want to take on as much risk. Some employers are willing to take on more. It's really comes down to the risk appetite of that employer. So just to give you two extreme examples, we've seen larger municipalities with very low stop loss deductibles because they just want the expense to be more fixed and they don't want a lot of volatility. The opposite of that, we've seen really small private equity companies who are cash flushed, who will take on much more risk in their stop loss policy because they have the dollars available. So instead of spending dollars with the tag on from the insurance company, they would rather just self fund that expense. So it really comes down to risk tolerance. Some employers, they're self funding various lines of coverage. So workers' comp is another example. And so sometimes employers will have a risk manager who looks at all the areas where they self insure an expense, and they're just looking to do that in a very holistic way.
What's the largest stop loss deductible that you've actually seen an employer implement?
We've seen $2 million as typically where it starts to tail off. We have $2 million deductible policies. And I would say once you get to roughly 10,000 employees, because as you increase in employee size, you start buying less and less stop loss coverage. So you get to a point where it no longer makes sense to have an even higher deductible. So I would say 2 million is where we see that tailing off. Once you get above that level, there's just so much volatility in the pricing, and a stop loss carrier or a reinsurer is going to add layers and layers of margin. And at some point, it just becomes an inefficient product.
Very interesting. So, Mabe, let's say there's someone out there and they want to learn a little bit more about stop loss, or perhaps they want to connect with you directly. Where can they go?
Yeah, just look me up on LinkedIn. I work for BCS Financial. We're a very large and well-known stop loss carrier and reinsurer. And if we can provide you any services, just feel free to reach out.
Awesome, Mabe. Thank you very much for coming on the show today. I really appreciate it.
Yeah, you got it, John.
Absolutely. And for audience out there, we want to hear from you. What additional questions do you have on your stop loss renewal? Comment below and be sure to join us for part two of our interview with Mabe, where we'll talk about what you can expect from your 2024 stop loss renewal.